Welcome back to the Deep Dive. It's January 7th, 2026, and we are here with your Essential Intelligence Briefing. And the last 24 hours have really pulled the market into a perfect knot.
A perfect knot is a great way to put it.
You know, if we had to give this deep dive a title, I think it would be the institutional paradox. Because we are witnessing just a violent collision between two incredibly powerful forces. You have the long-term structural expansion of Bitcoin by Wall Street.
Right, the big picture stuff.
And that is crashing directly into this acute short-term friction, unexpected supply, regulators tightening the screws all at once.
And that collision is really what's defining this moment. For the first time, you could say Bitcoin has truly graduated. It's at the adult table of global finance.
And it's dealing with adult problems.
Exactly.
Yeah.
So our mission today is to unpack that paradox. We're going to look at how the biggest banks are solidifying the asset class, while at the same time you've got miners and regulators creating this supply overhang and a lot of complexity.
Okay, so let's start with that structural pivot because, the headlines are just screaming this morning. Morgan Stanley.
Yes. Morgan Stanley just made a monumental commitment.
This is more than just them selling other people's products, right?
Absolutely. This is a definitive structural escalation. It really can't be overstated.
So specifically, they filed S-1 registration statements. One for the Morgan Stanley Bitcoin Trust.
Which was expected, eventually.
But also, and this is the big one, the Morgan Stanley Solana Trust.
That's the real bombshell in the filing.
Okay, but I have to challenge this a bit. Is Morgan Stanley really leading here, or are they just, playing catch-up to what BlackRock and Fidelity did with the first wave of spot ETFs?
That's a fair question, but it's about the structural implication, not just the timing. Think about the value chain.
Okay.
Historically, a firm like Morgan Stanley, they're the gatekeeper. The distributor. They sell products that BlackRock manufactures, and they take a little fee.
Right, a distribution fee?
By filing for their own trusts, they're moving to become the manufacturer. They want to build the car, not just sell it. They internalize the custody, the management fees, the entire economic stack.
So for a firm that guides trillions in assets, that's a massive shift in leverage.
It's a game changer. That's what we mean by crossing the Rubicon. They aren't just selling a product anymore. They are the product.
And let's get back to the Solana Trust filing. That feels like the most aggressive part of this whole move.
It absolutely is. This is what makes their move so different. The Solana Trust filing, it effectively elevates SOL to the status of an institutional-grade commodity.
Putting it right alongside Bitcoin and Ethereum in their view.
In the institutional view, yes. It's an incredibly forward-looking maneuver. It basically preemptively challenges the SEC's historical hesitation on securitizing any altcoins. Morgan Stanley is staking a claim on the future institutional portfolio, not just the Bitcoin part of it.
Okay, so now we have to swing from that immense long-term bullishness directly into the immediate market pain. This is where the collision you talked about gets physical.
Right, from the boardroom to the order book.
After absorbing nearly $700 million the day before, the U.S. spot Bitcoin ETF complex recorded a massive net outflow of $243 million.
And that kind of reversal just highlights the type of capital that's in the market right now. This isn't long-term, HODL money yet. This is fast money. It's very sensitive to momentum.
And the main driver was Fidelity's FBTC. It saw a staggering $312 million walk out the door.
Which suggests some very large allocators were just waiting for the price to hit that ceiling to take profits.
But here's the crucial divergence. BlackRock's IBIT was still resilient. It actually recorded a net inflow of $229 million.
And that divergence is key. You have to watch that. It confirms that institutional money isn't just fleeing the asset class entirely. It's rotating, maybe rebalancing between providers or just taking some risk off after a big run-up.
But the reason for the profit-taking is clear. Bitcoin stalled. It was decisively rejected at that psychological $95,000 barrier.
A hard rejection.
We really need to explain the mechanics of that. People are calling the $95,000 level a gamma wall. What does that actually mean for, the person holding Bitcoin at home?
Right. It sounds very technical, but the concept is pretty simple. Think of it like a big reinforced steel door that automatically pushes back the harder you push on it.
Okay, so it's a defensive mechanism.
Exactly. A gamma wall is just a huge concentrated pile of open interest in call options contracts, all sitting at or near that 95K price. So as the price gets closer, The market makers who sold those options,
Their risk models go crazy.
their risk models basically force them automatically to sell spot Bitcoin to hedge their exposure, to stay risk neutral.
So it's not even about fear or sentiment. It's just pre-programmed selling.
It's totally passive and automated, and it creates this enormous but temporary supply barrier. You need a truly massive wave of sustained buying to break through something like that.
So with that rejection and the huge ETF outflow, what's the silver lining here in the price action?
The silver lining is the defensive structural support. I mean, despite absorbing $243 million in outflows and hitting that wall, the bulls successfully defended the $91,800 level.
And that level used to be major resistance.
Exactly. It's a classic resistance turned support flip. So the outlook is still very much a buy-the-dip regime, but only as long as the price holds above, say, $91,500. That level is the foundation we just can't afford to lose.
Which leads us to the other side of the equation, supply.
Yeah.
We've covered the Wall Street demand, but where's all this unexpected supply coming from?
Yeah.
And we have to look at the miners.
Yes, the mining sector signals are stark. You're seeing rising opacity and some really aggressive inventory liquidation.
This is the friction we were talking about.
It's the perfect example. Difficulty is high, margins are thin, and it's forcing some huge players to become net sellers into the market.
Let's focus on Riot Platforms, a giant in North America.
Yeah.
Their inventory dump in December was, well, it was massive.
It really was.
They sold 1,818 BTC. Their monthly production was only 460 BTC, so they sold nearly 4 times what they mined.
Generating $161.6 million in cash. And the implication there is crystal clear. Riot is injecting a ton of non-organic supply into the market.
Why? What's the strategy?
They're funding a strategic pivot. They are liquidating their Bitcoin treasury to pay for a huge capital-intensive build-out into artificial intelligence and high-performance computing.
So for Riot, Bitcoin is now a funding mechanism.
Precisely. It's no longer a sacred, untouchable reserve asset. It's funding for their energy infrastructure business. They are optimizing for power, not just holding BTC.
And then there's the announcement they made alongside this, which introduces a serious transparency risk for anyone invested in that sector.
Absolutely. They announced they're stopping their monthly operational reports. They're only going to report quarterly now.
So you, the investor, are basically flying blind for 3 months.
Completely blind. You won't have real-time data on their power issues, their struggles, or, and this is the most critical part, if they're continuing to dump their treasury to fund this AI pivot. That kind of opacity is deeply worrying.
Now, to be fair, not all miners are doing this. We should provide some contrast. CleanSpark, for example.
Right. CleanSpark represents a much healthier sort of market-neutral strategy.
They mined 622 BTC and sold 577 BTC.
Which is basically a sell-what-you-mine model to cover your costs. They have a high hash rate, really sophisticated energy management. It shows you can be resilient, but you need operational excellence, not just a treasury to liquidate.
And then you have this ingenious, almost funny pivot from Canaan Inc. in Manitoba, Canada.
The tomato greenhouse, yes.
They are integrating liquid-cooled miners to capture waste heat to warm a commercial tomato greenhouse.
Yeah.
High-performance computing heating tomatoes.
It sounds lighthearted, but it's actually a vital economic strategy for survival, especially after the halving. By monetizing that waste heat, which is just lost energy otherwise, you're effectively lowering your net electricity cost.
So for smaller miners, these dual-use systems are becoming essential.
Essential for survival in this high-difficulty environment.
All right, let's move to our fourth point of market friction. The regulatory environment. It feels like the landscape is just hardening into a defensive siege by incumbents.
It's a coordinated effort, for sure. Regulators in the traditional finance world are targeting the ways crypto operates outside the established federal perimeter. They're tightening the screws.
On the U.S. legislative front, Senate Republicans delivered a closing offer on that crypto market structure bill that's been stalled forever.
And they're adding new titles. The focus is aggressively on investor protection and, more importantly, on combating illicit finance.
And the timeline here seems to be the critical takeaway.
The timeline is everything. Banking Committee Chair Tim Scott signaled a target markup date of January 15th. They want to force a vote on this. And adding the illicit finance language is a strategic move to attract moderate Democrats by tying it to national security.
So the odds of this passing are higher than they've been in years.
Much higher. It's moving faster and more seriously.
Meanwhile, you have the traditional banking world launching its own coordinated offensive aimed right at crypto exchanges.
The ICBA and the ABA, the big banking lobbies.
And they're demanding Congress close what they're calling the Genius Act loophole.
This is a high-stakes turf war over liquidity. You have to understand, the Genius Act banned stablecoin issuers from paying interest, but the exchanges found a way around it.
By offering high yield or rewards on stablecoin holdings through lending or staking.
Exactly,
Right.
which is effectively paying interest.
So why do the banks care so much?
Because they argue it sucks liquidity out of their regulated community banks. It reduces the capital they have for traditional loans, which is their whole business model. Closing this loophole would threaten the core revenue of exchanges like Coinbase.
It could force billions of dollars back into traditional savings accounts.
Potentially, yes. It kills the high-yield value prop for holding stablecoins on an exchange.
And this regulatory siege isn't just a U.S. thing. Globally, South Korea's Financial Services Commission, the FSC, is proposing a payment suspension system.
And this introduces a truly chilling precedent.
How so?
This system would let regulators preemptively freeze crypto accounts they suspect of price manipulation before they even have a court order.
Wow. So it's guilty until proven innocent?
That's the model, yes. It introduces massive regulatory seizure risk for any trader in that major global liquidity hub. That kind of power can just instantly shut down a market.
Okay, despite all that friction, let's end on innovation. Let's focus on where this is all going, where assets converge. The everything exchange idea seems to be rapidly emerging.
It really is.
Just look at BitMEX. They've launched equity perps, perpetual swaps on U.S. stocks. We're talking NVDA, TSLA, SPX.
And this is the key part.
Tradable 24/7, using crypto like USDT or Bitcoin as collateral.
This is a fundamental attack on the market structure of traditional finance. It breaks the monopoly that the NYSE and NASDAQ have on trading hours.
Suddenly you can hedge macro risks or take leveraged bets on stocks over the weekend.
Without ever touching fiat, and the technology behind it is critical. The product is powered by Chainlink data streams. You're seeing the on-chain exchange Lighter do something similar with 245 synthetic equity perps.
So this confirms that everything exchange thesis for DeFi.
It does. The system is evolving into a place to trade all assets, not just crypto, with better uptime. And it creates a seamless new way for volatility to transmit between the crypto and equity markets.
Finally, we have this massive Trojan horse moment for stablecoin adoption. Sony Bank confirmed plans to launch a USD-pegged stablecoin in 2026.
This is a story about scale and stealth adoption. Sony is putting stablecoins directly into the PlayStation and Sony entertainment ecosystem.
So millions of non-crypto users, just gamers buying things, will be using stablecoins.
Exactly. It'll be the native currency of their platform. It normalizes usage for a mass consumer base that might not even realize they're interacting with crypto. It's mass adoption through the back door.
Okay, so let's synthesize all this intelligence. The market is deep in what you could call an institutional digestion phase.
I like that framing.
The long-term drivers are immense.
Yeah.
Morgan Stanley becoming a manufacturer, Sony normalizing stablecoins. That's all relentlessly bullish.
But the tactical risks are sharp, and they are immediate. The ETF outflows, the riot supply dump, that tightening regulatory noose.
So what's the outlook?
Consolidation is the most likely near-term outcome. I expect we'll see choppy sideways trading, probably between that $91,500 support and maybe a $94,000 barrier, until that gamma wall resolves.
With the Q takeaway.
The most telling data point is that the market absorbed a huge ETF outflow and a massive miner dump without breaking its structural foundation. The underlying demand is proving to be incredibly resilient.
Which brings us to our final provocative thought for you to consider. The geopolitical dimension is always lurking. Specifically, this persistent, though unverified, narrative about Venezuela's alleged 600,000 BTC shadow reserve.
And it is highly unverified. Blockchain intelligence firms have cast serious doubt on whether a single 600,000 BTC wallet even exists. They think the figure might be an estimate from years of illicit oil for crypto swaps.
Yet the market might be subtly pricing in a kind of lockup premium. The belief is, well, if those coins do exist, the U.S. seizure of the regime means they're effectively frozen or burned. A rogue seller is off the market.
Right, a supply shock to the upside.
So the question to boil over is this. What happens to the market, and what immediate sell pressure would we face if proof were to emerge that those coins were actually secretly liquidated onto global markets before anyone even knew they were captured? Something to think about as you navigate the complexity of this institutional paradox.